Lots of times in the tax business, we talk about different ways to legally avoid taxes. One of the absolute best ways to legally avoid taxes is oftentimes investing in real estate. Real estate can have massive tax benefits that anyone who owns it can take advantage of, but some people can take advantage of more of them. One of the really nice things about real estate is something called depreciation. Depreciation means that you get a phantom expense, a negative number to put in your taxes, but you're not actually spending really money. It accounts for the fact that buildings wear down over time. Now, many things have depreciation, cars, tools, computers, etc. But most of those things are actually going down in value faster than the depreciation. So it's not really necessarily saving you any money. The weird thing, of course, is that in real estate, there's depreciation as the building is wearing down, but the actual real estate is almost certainly consistently going up in value or appreciating, which lets you, again, take advantage of that phantom write-off on your taxes. Typically, it is depreciated. A house or any other residential property is depreciated over 27 and a half years. Now, only the building is depreciated. The value of the land is not. So let's say you buy a house for $300,000, maybe $50,000 of that is the land price, and you get to depreciate $250,000 over 27 and a half years. That's a $9,090 deduction every single year you get to make on your taxes. That's in addition to any actual repairs or improvements you make on the property. So if your tenant destroys the carpet or the walls or something like that, you still get to do the depreciation. Now, depreciation only applies to investment properties. You can't depreciate the home you live in unless it's a duplex or a triplex or something, in which case you can depreciate all of it that you don't live in. Now, this loss in on your taxes will tend to detract from any gains you have. And my experience is that almost any property for the first 5 years you buy it, this depreciation will be a larger amount than any sort of cash flow you likely gain after paying off things like the mortgage and the property taxes and insurance and all of those things. There are some other things you can do that can supercharge this. One of the really interesting things that's still available is called bonus depreciation. Bonus depreciation lets you depreciate part of a property in the year you buy it 100%, or it used to be 100%, instead of having to do that 27 and a half years. So you can divide up a property into not just building and land, but you can say, well, what about all the fixtures in the house? Things like the carpeting and the walls and the drapes and the light bulbs. Well, those aren't going to last 27 and a half years. And depending on the type of property that you typically can depreciate those over 5 years or 15 years. But in the Trump tax cuts, there is a provision that for a number of years, you could instead depreciate 100% of that in the year you purchased a new residential or commercial property. Now that's been dropping. It was only 80% of that number last year, and it's scheduled to be 60% of that number this year. There are proposals to change it back to 100%. But that it can lead to some very interesting additional planning abilities for somebody. I have a friend who invests in apartment complexes. She goes and finds apartment complexes, raises money to buy them, runs them, and then sells them. And her husband is a surgeon making over $300,000 a year. By taking advantage of the depreciation she's gotten and the bonus depreciation she's gotten over the past 4 years, she's paid no income tax. Now, finally, this year, she told me she is going to owe some income tax because she, for the first time in a number of years, didn't buy a new property, so she doesn't get bonus depreciation. But as you can imagine, the income tax on $300,000 of wages for a surgeon is a lot usually, and she's completely avoided that again for 4, maybe 5 years now. Now, you can't just have a loss and write it off against your income ordinarily. You have to be with something called a real estate professional to write off a real estate loss off of your work gain. That's because the IRS categorizes certain gains and certain losses differently. Some are active, some are earned, and some are passive. Technically, the IRS doesn't call any active, it's just kind of the default. And then earned is a special type of that where you owe payroll taxes as well. But then there's passive gains and passive losses. And that can be things like gains from holding a stock, gains from buy and hold real estate. You cannot use all of your passive losses to write off your active gains under ordinary circumstances. Well, you technically never can. There is just a way to take your passive losses in real estate and turn them into active losses. And that is by having somebody in your family, a husband or wife in a married couple, or if you're not married yourself, becoming what's called a real estate professional. This has nothing to do with being a realtor or buying or selling real estate directly. Instead, this is a series of tests the IRS looks to see if this is actually a job for you, basically, instead of just an investment. There are very strict requirements to this, and a lot of people who fake this do get caught. So don't do this just because you're going to save in taxes, or when they catch you, your taxes will be a lot higher with all of the penalties and interest. But if you do meet the requirements, it's absolutely great. The main requirement is you have to spend more than 750 hours a year working on the real estate. And you have to spend more time working on real estate than than all other jobs combined. That second thing is what usually makes it hard. You know, if you have a 40-hour-a-week job, you need to spend more than 40 hours a week on real estate to do it. But it's been done. There was a nurse that somewhat famously was working 3 12-hour shifts a week and managed to work 40 hours a week on real estate, and so would have passed the test on that basis. Sadly, she filled out the form wrong, so it didn't count, but otherwise she would have been a real estate professional, even having a full-time job. It is a strategy I commonly see husbands and wives do when one of them does not have a regular job. Maybe they're a stay-at-home parent. If you have that stay-at-home parent take over the real estate and actually spend the 750 hours a year, which is 15 hours a week, basically, then you can have these losses in real estate that you can use to write off the gains in your income. And I took advantage of this myself with my wife. There were several years where we bought properties and used the passive losses to avoid paying taxes on a lot of the income we had, making a 6-figure income and paying a 4% or a 5% tax rate on my income after all the deductions we got to do. Now we're not going to be doing that in 2023, and we're not likely to do that in 2024 because our living situation has changed. But it is another tool in the toolbox to have to, again, 100% legally avoid taxes while you're building wealth. And I do love real estate. We have 3 single-family houses. Myself, we are investors in 3 apartment complexes at about 1%. And it's nice having that money coming in every single month. And because of the depreciation and all those sort of things, it kind of functions as tax-free cash flow every month when those rent checks come in. Even if technically it's not tax-free, it functions that way because those passive losses on the depreciation and everything else offset those gains. There are a lot of ways to run a business and build an income for yourself, but I am still convinced that real estate is the best way for the average person to legally avoid as much in taxes as possible, and also to build wealth by having multiple different income streams and appreciating assets. Now, a lot of people who are in real estate know about the depreciation. They know about something called 1031 exchanges and other ways to get money out of their properties without selling the properties. The thing a lot of real estate people don't really do very well is they don't treat the real estate like a business. And real estate is a business, and you can take every normal business deduction for your real estate business as long as you can meet the requirements to take a business deduction. So if you need to have a cell phone and a home office for your real estate business, you can deduct those things. If you go to conferences or events, Though that travel, those expenses can all be business deductions from your real estate business. Now, again, if you can't use those losses because you're not in an active business, it's not going to help you nearly as much as other businesses. But they don't go away. Even if you have, if you have, say, $5,000 in losses for 10 years, well, when you sell the property or when you become an active real estate investor, you can then use those losses as long as you kept putting them on your taxes every year. But I really do think a lot of real estate investors, especially like professional real estate investors, they have, 30, 40, 50 houses, really should take better advantages of the various tax savings that can come from running their business like a business and not just treating it like real estate. If you are interested in learning more about this, please reach out to me at agoristaxadvice.com/real estate. Once again, Agorist, AGORIST, taxadvice.com/real estate. I'd love to help other real estate investors figure out ways to improve their business and ways to save taxes. I love to help people get involved in real estate in the first place. And if you don't have a business, getting into real estate can be one of the easiest businesses to get into. It basically just takes time or money instead of time and money like so many other businesses. Thanks for listening.